All right. Welcome everyone to today's webinar. So, during today's live stream, we'll be basically talking about the 2020 housing boom and whether it's done with, or it's still going to be going, despite the fact that unemployment is still relatively high and all the other lovely things that 2020 has brought up so far. So let's see what the stats look like in terms of the actual numbers for September. All right. So let's very quickly look at the September housing stats from provided by the CREA. All right. So the big kind of overarching take home is really that national home sales have been rising, so about 1% month over month. So number of homes being sold has increased. Actual activity year over year is up 45.6%. And then newly listed properties have increased by about 10% month over month. So quite a few new listings. Now, if you're looking for the actual price increase year over year, so this is the average national price. This is not the seasonally adjusted or anything like that. So this has been 17.5%, which is quite substantial in the grand scheme of things, if you think about it. All right. And by the way, I've already included all the links down in the description. So check these out at your own pace. So this is basically all the data that I'm going to be showing you and discussing today is right here. So what you want to be doing is obviously you want to have a very quick look at the new residential listings. So this particular graph here is actually from the previous month. So basically it shows you July and August. Now obviously September being a quarter end month, the updated numbers are actually, we're just seeing the average quarterly numbers here. Okay, so here you have basically July, August, and September combined. And here before you had July, August, and notice what the number of new listings are listed, are mentioned over here. So basically, it just tells you that we're very close to a record high listings, in recent years at least. And obviously, part of that reason is because we had record low listings in the second quarter of this year with the COVID-19 shutdowns. And now, residential sales, obviously. Again, these are data from the previous month. So if you're looking at July and August, this is what you're getting. And now if you're adding September numbers and averaging it for those 3 months, for basically the most recent quarter, you're averaging everything up. This is pretty much what you're going to get here. So you can clearly see that there's a massive increase in residential sales. Again, you're just looking at the raw data. It's not seasonally adjusted or anything like that. Sorry. This one is seasonally adjusted, the one above there. There you go. Because I'll be showing you some of the other data on the next slide. That one is not seasonally adjusted. I just got confused which one is and which one isn't. Anyway, so then you also, if you're looking at prices in terms of by how much have prices actually increased, obviously the Canadian average of 17 and change, that one is not really that indicative because a national average doesn't reflect individual areas, individual cities, etc. So if you were to actually try to break it down at the very least by province, then you basically see this year over year percentage change. And this is not seasonally adjusted. So this graph here is not. The other ones were seasonally adjusted. And again, whenever they're seasonally adjusting something, they're looking at what is a normal number of sales that you would see in that particular month, in that particular quarter, and they adjust the numbers accordingly, basically. Okay, so main takeaway here is that yes, right now this is basically August 2020 to August 2019. So we've seen there were still quite high increases here in Quebec and Ontario on top of the eastern provinces. And there's a bit of overall overlapping, they contributed significantly to the overall Canadian average. Obviously, Alberta was doing really, really not that great in August. Now, if you're looking at September, this is how numbers have shifted. So now you really see sort of this larger spike in New Brunswick especially, but most of the Maritimes with the exception of Newfoundland. So basically, and this tells us that a lot of people are looking for options in slightly less populated areas. And obviously here for the Atlantic provinces, you have the Atlantic bubble. So a lot of people in recent weeks and recent months really have been starting to look at potentially moving across provinces and continuing to work from home in their current positions, but just that way, to reduce the risk of having to go through another lockdown, or to reduce the risk to their own safety or not. Whether that's the right approach or not, again, that remains to be seen. But basically, this is what really contributes significantly to the increase and to the spike in prices in Eastern Canada. So all of that data was from the CREA. And as is the one on basically this slide here as well. So here we're just looking at the 10-year monthly moving average. So this is a monthly moving average that is seasonally adjusted overall. So you can see sort of these overall increases in number of homes being sold. And then obviously here we had a massive drop because of the lockdown this spring, and now we have a massive resurgence that seems to continue the same trend as we've seen in July and August. It continued in September as well. Now, this is their benchmark price. So keep in mind the benchmark price, whereas the other prices that I showed you earlier, they were just average prices. They weren't really comparing any subtypes of homes to any other ones. Whereas for the benchmark, you're literally comparing the price fluctuations compared to similar other subtypes of homes. You're not just looking at the overall price, right? So where are these large price increases? Well, as you can see, the composite, so that's the average of everything, is the black line here. But you've seen the largest spike in basically 2-story single-family homes, quite a bit of a spike as well in 1-story family homes, and then a smaller spike, but still a significant spike in townhouses / row houses, and the smallest one in condos, basically. So all of this to say that we see this divergence in the demand and in prices, whereas a lot of condos have been flatlining or even declining in certain areas. There's more and more demand, especially in the higher end, larger homes, single-family detached 2-story homes across Canada, and this is true based on the CREA data, as well as based on other data from, for instance, CIBC and from National Bank and Teranet, which I'll show you over in the next slide, basically. So this is the overall residential market balance. On the left-hand side, it shows you the number of months. If you were to keep on, selling homes at the exact same rate as the current month, it shows the number of months of inventory. And on the right-hand side, it shows you the sales to new listings ratio. So what is the relative percentage of all new listings from that month that have sold during that month? So you can basically see that the current inventory is about 2.7, 2.5, right? Because right around here it will be three months, so about 2.5-ish months worth of inventory. So that's very, very low, especially if you're just looking at the last 5 years or so. Inventories are very, very close to record lows. We had other very low inventories in previous years, but again, this is just the data we're having here. And then finally, the sales to listing ratio, again, it's very close to all-time highs in the high 70s, so about 77, 78% of all listings sell basically within a month or so. Okay. So again, this keeps on kind of confirming the fact that the Canadian housing market seems to be really pretty much on fire. And when I say on fire, I'm not saying I'm not trying to say it's collapsing like something that burns, but it literally is on fire, as in it's really expanding exponentially. Now the problem is, in that same analogy there, right, is with every single fire, eventually fires do peter out, especially if you're just trying to consume all the available fuel, i.e. people's money right off the bat. So let's look at a few other data points, not just at what the CREA is providing, because again, sometimes depending on how you're analyzing the data, whether you're averaging it out a little bit more or you're comparing it more to benchmarks, sometimes a bit more conservative, other times it's a bit more more out there, shall we say, to use a nice term. So in this case, this data set here, this is from the the second link in the description down below. Basically, this is from the let me just double check this. Okay, there we go. Okay, so this is, YouTube was having a few issues. I think live stream, there might be a lot of people live streaming right now because I keep on getting warning signs here. But anyway, so basically, as I was saying, this is from the Teranet and National Bank index over here. So again, second link in the description down below. You can check it out yourself. So overall, these are the, this is basically how the price, this particular index has performed. Keep in mind, this is the index, so it's always adjusted for a number of things. So this number also takes into account here only these 11 cities, right? So it basically takes into account Montreal, Quebec City, Halifax, Ottawa, Toronto, Hamilton, Winnipeg, Edmonton, Calgary, Victoria, and Vancouver. Those are basically the 11 indexes that it's taking into account. So then you can basically pick and choose other smaller cities that they also have data for, but which are not part of this overall average. So depending on how many different data sets you're taking, your national averages will obviously be a little bit different. Because if you're just considering the large cities, then obviously you might have more of a move in those and not so much in other places, for instance. All right, so let's say we're picking Montreal out of curiosity, and you can basically see how Montreal has done. So year to date, the price has gone up by 10.48%, year over year 11.1%, month over month 1.87%, based on that particular price index that they're having. Okay, so these are not necessarily real prices; these are the prices adjusted to be part of that index. Okay, let's say you're also looking at like Toronto. Can see that there's still a significant increase year over year. Again, on average, you would expect about a 3.4 to 3.7% year over year return if it was an average standard year. So this is an excellent year really for real estate in terms of going or increasing by about close to 8%. And keep in mind that the raw data is around 17% nationwide, whereas here the index data nationwide for all indices is about 8.2%. Okay, so the index is a lot more conservative, but not in either case. In both cases, so in whether you're looking at the raw data or you're looking at the index, clearly it's a really, really, really good year for real estate. If your definition of good year is how much more expensive is your real estate now compared to last year. The massive problem is obviously we're in the middle of a pandemic still. There's still close to record high unemployment. It was worse earlier this year, but with more and more shutdowns looming, it's likely to be bumped back up to similar levels that we've seen, unfortunately, that we've seen in April and May. Again, time will tell. But so these are the numbers for now. So you can see here the overall performance of this particular index on the left-hand side. Again, they're just showing you the 12-month change. So here we see that 8-ish or whatever, 7-point-something% overall change for the whole of Canada. And then on the right-hand side, you just see the value of the total index here, going back to 2005, where it's adjusted for 100, basically. All right, so this we've already seen here. Now, what is kind of the main takeaway from this index? Because everything else is very similar. They're also showing differences. Again, just the only difference is between this and the raw data is that these numbers are a bit more conservative, but nonetheless, you'll have the same increases in the same areas as you've seen with the CREA numbers. So the main takeaway here is that your composite index sale price rose by basically 1.07% month over month, and by about 6.71% year over year. Now, a third report, so this is your third link in the description down below. This is quite interesting, is by CIBC. right? Because so far we've discussed in the past that obviously record low interest rates definitely increase the likelihood of people wanting to borrow money. We've also discussed that not having a spring market has kind of shifted that usual high spring demand over the summer and now early fall season. So that's not unexpected. And we've also talked in previous sessions, and when I was talking about the August and the July numbers, and a couple of months ago, basically, we were talking about how there's an increase in the desirability of single-family detached homes because people don't like to live in condos anymore, at least currently with COVID-19 going on. And in case there's another lockdown, people like the higher flexibility living in a single-family detached home that actually has a bit of a backyard would give them. And then obviously, if you can keep on working remotely, and if it looks like as though you would be working remotely for a few months, if not a year or so going forward, a lot of people might be thinking, it might be worthwhile buying something a bit further away from the big city, still within a manageable commute, but that way I can buy, for $500,000, I can actually buy a reasonably sized house. Whereas if you want to buy a single family detached home on the island of Montreal or in Toronto, good luck with that and finding something reasonable in those cases. Now, obviously, the flip side of this is no one knows for certain for how long the pandemic will last. As a result, that demand might vanish a lot faster than expected if we get a vaccine, by the next fall or what have you, and decent treatments, etc. And you might have some people developing natural immunity to begin with, etc., etc., etc. We might, go back to in-person work sooner than a lot of people are expecting. Might still take a few months or maybe a year or so, but typically when you're buying a house, if you're buying a house in Nova Scotia but you're actually working in Toronto, maybe some companies will be fine going forward allowing people to work indefinitely from home. Quite a few of them have made those statements in the past already, but it's not a guarantee that every single job will be that will be an option for every single employee at every single location for every single job, right? So as a result, a lot of people that are selling their condos or their houses downtown Toronto and then buying something on the East Coast might be stuck in a very big bind where now they have a really gorgeous large property with a nice beautiful home that they bought for ridiculously cheap compared to what they would have bought in Toronto. And that's part of the reason why prices in Nova Scotia and the eastern Canada have been rising so much, because you have a lot of people coming from other parts of Canada that are trying to buy. But at that point, if you have to go back to work, commuting between Halifax and Toronto, or even smaller communities on the East Coast and Toronto, or even Montreal, is not really a thing you can do on a daily basis. So a lot of people might regret those decisions based on their finances and their particular specific situations. Anyway. So where does that leave us with housing? Because these are just the numbers. Okay, housing numbers have been rising, and again, those factors we've discussed already. But are those really the only factors? And also, can they tell us anything about where housing is heading within the next few months or maybe a few years from now? Well, in order to do this, again, this is why this CIBC report is quite interesting, because it goes into a bit more detail than those standard monthly reports from the CREA that just shows you kind of what are the average prices doing, and that's it. It's very it doesn't really analyze in terms of what's going to happen next, whereas this at least gives you some ideas. It's not a guarantee that it's right, but anyway. So next few graphs that you're going to be seeing are basically from this last report here. So they've also looked at average sale prices, and as you can see, yes, average sale prices have definitely been increasing. So average prices have gone up, no surprise there. And in terms of the number of units, that has also gone up. Now, it's also worth mentioning that the total number of units, whenever I say units, I do talk about condos, but also single family detached homes. So all homes, the number of real estate transactions in the country is still below the average amount for this time of the year, right? Because despite the fact that we've seen massive increases in the number of transactions in the last 3 months, there was no real spring market. So as a result, there's there's still quite a bit of catching up to do overall. But number of sales, has gone up. The prices have gone up on average, and then the number of listings obviously has increased exponentially because what you would normally see here, the spring market kind of doing this, didn't happen this year. So because of that, this is what you're getting. All right, so that's not a surprise so far. So again, I have about 5 more charts to show you on this wrap-up page here from that same report. So just to wrap things up before I kind of go into the more nitty-gritty of things. So as I said, prices have increased substantially in the past 3 months. No one will be denying this, okay? Whether that substantial increase is reasonable or not, given the number of people that are unemployed, given the pandemic is still raging and we don't know what the short and long-term consequences are necessarily going to be, it's a massive question mark whether this is necessarily a good or a bad thing for the economy and for individuals in general. So what are some of the main factors that have contributed to this? Well, as I said, low mortgage rates. Now, the thing is, you have to kind of break that low mortgage rate statement into a little bit more. And this is why I'm really happy that that's exactly what the CIBC report did. And by the way, the CIBC report is relatively recent, so from October 8th. So it's really not that old. So here it's comparing both variable rate mortgages and fixed rate mortgages in terms of how was the actual, like how low or how high was the your average mortgage, your average variable rate mortgage back in 2008, 2009 during the most recent recession, and then how is it now? So in red, it basically shows you what the average mortgage was for a variable rate back then. So it was around 3%. The average fixed rate mortgage right now, again, those are based on whatever the Canadian bonds, government bonds with the same maturity as the mortgage term is. There, back in 2008, 2009, those bonds were around, 3.5 or 4%. As a result, mortgages were also around, 5-year fixed mortgages were around 4%. Back in those days, there was no such thing as a stress test. That has been introduced more recently in the last few years. So right now, obviously, we have even lower mortgages. Right now, you can get a sub 2% mortgage. Between about 1.5 and about 1.9% mortgage is not uncommon for a variable rate mortgage, and around 2%, so 2.25 or thereabouts for a 5-year fixed rate mortgage. That's again quite common as well. So the actual mortgage rates right now are lower than back then. However, and that's basically what you end up paying at the end of the day. However, the stress test, right, is put into place to make sure that people can reasonably afford their mortgages, not just now, but also, when it renews in 5 years, 10 years time from now, when interest rates are really pretty much guaranteed to be higher than right now. Will they be higher by 0.25% or will they be higher by 3%? It's anyone's guess, really. So because of that, you have this additional stress test. The way the stress test works, in case you're not familiar, is that the bank basically says, all right, so what is your current level of income? How much other debt do you have? How much of a down payment do you have? How good or bad is your credit score? But they'll basically be focusing on how much other debt you have and how much your income is, and what is your gross debt service levels. What are your gross debt service levels? In other words, how much of your overall monthly bill and your overall monthly debt does your mortgage represent, and then they will basically run the calculations as if you are currently qualifying for the higher mortgage rate, which is the kind of the stress test adjusted rate of 4.79%. Okay, it doesn't mean that your mortgage, if you qualify for one that that is like, let's say 1.75%, right? The calculation of interest will be based on the 1.75. Your payments, your monthly payments will be based on the 1.75. But in order to be allowed to get that mortgage, in order to be approved for that mortgage, they're running the scenarios for both the variable and the fixed rate as though you would be getting a mortgage with a 4.79% annual interest rate. So because of that, despite the fact that mortgages are ridiculously cheap right now, and they're cheaper than they were in 2008, 2009, people, in order for them to be eligible to apply for those mortgages and be actually granted those mortgages, they have to pass that test at 4.79%. Okay, so a whole 3%-ish higher than what they would otherwise qualify for and actually pay for. Okay, so yes, cheap money is a thing, but technically speaking, despite the fact that the actual percentage that you're paying and the actual interest that you're paying on a monthly basis is lower than it would have been in 2008, 2009. Overall, in order for you to be approved to get said mortgage, you have to prove your ability to service a mortgage that is about 3 times as high or about 2.5 times as high as in the one that you're actually getting. So low mortgage rates play a role, but it's not quite as simplistic or obvious as a lot of people might think. Also, very important for this particular recession is that over 80% of jobs that were lost and that are still currently lost are primarily in the relatively lowish paying service sectors, right? Obviously, there are some relatively high paying service sector jobs, but overall, all things considered, if you're looking at which employees in which sectors make a bit more money, service sector definitely gets paid less, are more blue collar type jobs than, for instance, in the finance industry, which were mostly, a lot of jobs that were lost in 2008, 2009 were in that sector, right? So because of this, so here this graph simply looks at what is the relative percentage of relatively low-paying jobs, in this particular case, service jobs that we're seeing right now. So it's about 80%, whereas those same categories of jobs, it was only about 55% in 2008, 2009, and then in 1990 stock crash, we had about 50% of them were low-paying jobs. So why does this matter? Well, if you're still unemployed, you cannot apply for a mortgage unless you literally, have 99% down or some ridiculous high percentage. In most cases, banks will not approve you for a mortgage unless you're employed currently. Receiving government benefits doesn't help either in order to getting approved typically. Again, unless you have a massive down payment. What this means is that those people that basically wouldn't qualify for any mortgages right now would be typically the people that make less money. Typically, the people that make less money cannot really afford to buy a $3 million home. As a result, the vast majority of homes that aren't really in high demand are lower priced homes for 2 reasons. Number one, fewer and fewer people want to live in condos right now. Again, short, medium term, maybe long term might be a different story. And number two, you have, again, people that would otherwise want to maybe live in a smaller single-family detached home because that's the only one that they can afford and less expensive one. Those individuals might not be able to afford homes right now because they're out of a job, right? So as a result, the people that are currently applying for mortgages and securing them tend to usually be people that are still employed. In other words, are probably making more than the average or substantially more than the average Canadian makes. And those individuals rarely look for really cheap houses. A lot of them will typically look at the average or slightly larger or significantly higher than average home, depending on who you're dealing with. So because of that, if you have an increase in the number of homes that are priced above average, you will also have a disproportionate impact on your average house price as a result, all right? So the fact that jobs were lost in these low-paying or relatively low-paying service jobs also helps explain why we might see this significant increase in the year-over-year house prices. I'm not saying there aren't increases because there's higher demand because people have lost their minds and they absolutely want to buy a house right now, but it definitely is also kind of accentuated by the fact that a lot of those houses that are being sold are actually are houses that are larger than average. So we've seen this kind of flight to the suburbs and remote areas that I mentioned before. So this is especially obvious if you're comparing the average sale price in red here, so that's just the average sale price, and then the MLS, or the multiple listing service home price index benchmark. So the benchmark basically adjusts the price increases and price changes in homes based on which homes are actually being sold. So if you're selling more large homes, then it'll only will only increase the overall price of the index by the relative amount that those homes are representative of that particular of the total market. So if large single-family detached homes only make up 20% of the market, I'm just making numbers up here, by the way, but let's assume that's true. At that point, and you see a 50% increase in price over price in year over year, they're not going to say it's 50% price increases for the entire market if you're adjusting it, right? Because they'll say, well, yes, it's 50%, but only for this 20% of homes, right? So as a result, the real increase is only 10%, right? 50% of 20 is 10%. So because of that, the benchmark price, or whether you're looking at condos, you're comparing how many condos you're selling versus other ones, and what the price variation is, and then you're adding those numbers together and figuring this average out. So you can see this very large discrepancy, or very large kind of disconnect between the benchmark and the average prices. So when you see average prices significantly outpacing the benchmark, that tells you that the reason you're seeing that large average price increase is because there are more and more larger, more expensive homes that kind of drag the prices up. All right. And just to further kind of drill this idea home, that it's really mostly these price increases are mostly due to more and more people buying single family detached homes, and especially larger single family detached homes. And especially in areas that typically those houses would be less expensive, now they're being pushed up higher, like, in rural Eastern Canada, for instance, right? So here on the left-hand side, they're looking at the overall percentage in terms of shares of transaction, the relative relative number of transactions for condos. And we can basically see in 2020 compared to all the other years, condos have, is the only one in the recent 5 years or so where there are fewer condos being sold right now than previous years. In previous years, we've had this increase. And the other thing too is, if you're looking at the number of units that are currently under construction, there are way more condos coming to market in the next few months and year than single family detached homes. As a result, there's sort of a lack of inventory, relatively speaking, for single family detached homes, which currently right now are in higher demand. And then right hand side, you see this uptick in single family detached houses compared to previous years. Okay. All right, one final chart here. Or actually, it's a final chart composed of two of them, just before I wrap up completely. So here, this is looking at the August 2020 numbers, and they're looking at the year-over-year change in terms of the number of detached homes and the number of months of inventory. So clearly, relative to last year, there are significantly fewer months, so about 1.5 months less of inventory of single family detached homes, whereas condos, there's almost a full month more of inventory. So if last year, the way to interpret it is, if last year it took, let's say, 3 months to sell the average condo, right now it takes 4 months. Again, the specific numbers, I'm just making them up, but I'm just saying, I'm trying to explain to you what these bar graphs, bars represent. And same thing with single family detached homes. If last year it took 2 months to sell, right now it takes 1.5 months less. So, most sell in 2 weeks, basically, is what this would represent over here. And then finally, the very last chart here on the far right, so it looks at the single family homes and condos separately, and it basically takes just the benchmark, so the yellow line here, and it breaks that yellow line into two. So both of these lines are the MLS HPI benchmark price, but now it breaks it down by subtype. Is it single family detached, or are these condos? And specifically, you can see that you see this massive price increase in single family detached homes, and a slight decrease, actually, if you notice it, in condos. We're not seeing a massive drop in prices month over month, but yes, so condos are pretty much, if you're looking, comparing it to March, condos are definitely lower now than they were back in March, whereas, single family detached homes are significantly higher than that. All right. So last thing, is this rise in prices in line with fundamentals? Well, that's a great question. And I have a little paragraph for you at the very bottom of my description of today's session that basically kind of tells you my take on it. So yes, if basically how should you interpret this? If you can afford to buy a home, buy it, right? This is all like it seems very overly simplistic perhaps, but literally if you can afford to buy a home and live in it for at least 5, ideally 10 years plus, then by all means buy it, especially right now, because you don't necessarily know where the market is going to go and how interest rates are going to move in the next 5-10 years because of the massive amount of debt that is being generated for maybe the next 2 or 3 years or so, but until COVID is finally and much better under much better control than it is right now. But yeah, so if you can afford it, by all means buy. Just be very mindful of the reasons why you're buying, right? You can always rent a single family detached home. If you're really scared of living in condos, or you just want to be in a more, have a bit of actual, grass in the backyard and be able to self-isolate in your home and yet still be able to go outside in case we have to go through multiple of these annoying waves of COVID-19, then yeah, that's reasonable. But just look for rentals. You don't necessarily have to buy. And again, in some cases, it makes a lot more financial sense to buy. In some cases, it makes a lot more financial sense to rent. So just look at your situation, look at what makes sense for you, and act accordingly, basically. And yeah, there's again, this is just speculation, as I'm saying in the very bottom of my little paragraph there. We might have a Canadian budget by some point or another in November, assuming there's no other mess like yesterday that we almost had to have a snap election with the confidence vote. But we'll see. There are some pundits that are forecasting that perhaps the government will bring in 30-year amortizations again for CMHC-insured loans. That would most certainly stoke the fires even further and keep real estate relatively high. Otherwise, yeah, once you have this kind of pent-up demand that is mostly due to people trying to run away from the cities and kind of leave the big cities and go move to single-family detached homes, there's a good chance that prices will stabilize or even decrease, and might decrease substantially, especially as interest rates will have to go up in case you're having high inflation or just over time. Now, they're not going to be going up anytime soon. They're not going to be going up, next year or so, but within the next 2 to 3 years, it might not be unheard of or impossible to imagine, a 0.25% increase in interest rates, for instance. So again, that last portion is more of a forecast, and obviously forecasts are incredibly difficult to be, it's incredibly difficult to know how accurate a forecast would be. But yeah, so if you can afford to buy a home, by all means buy it. Otherwise, if you're uncertain, if your job is uncertain, consider, renting instead. Look at condos. Again, condos will most likely be really, will continue to drop in price, and it might be really good, inexpensive buys maybe in a few months from now. But that's assuming you can handle the operational costs in the meantime, and the transactional costs, and you're okay living in a condo, because otherwise your money might be locked in for about 5-10 years from now until things kind of recover and become a bit more reasonable in the condo market as well. And again, the standard real estate market for single family detached homes, you categorically cannot have 30%, 20%, 15% year over year increases as we've seen in recent months. When you're still, when your economy is struggling, when there's more and more debt being kind of racked up by government, that's not something that can go on indefinitely. It might still go on for a few months or a few years potentially, especially if new government programs will be implemented to kind of boost housing even further, or kind of keep it afloat, as it were. But yeah, I'd be very, very cautious. Just make sure you can actually afford the real estate you're buying, and really think it through. Why is it that you're buying a home versus not? But yeah, currently it's definitely booming. It's definitely on fire. But as I said before, with any fire, there's also the danger of actually burning out. So just be very careful. A few months of, and probably potentially a few years of quite a bit of uncertainty, possibly. All right. So I hope you found this interesting today. And that's pretty much it for this session today. So I'll see you at some point or another in a future webinar. So everyone, have a great day and see you at the next live stream or